welcome to this special Talk Tickers edition of the Deep Dive.
Yeah, it's great to be here.
So, our mission today is clear, fast, and actionable, right? For you, the listener, we are breaking down the Q3 2026 earnings call for Cracker Barrel.
Ticker symbol CBRL.
Right. And we want to give you the 3 or 4 most critical takeaways in under 5 minutes. Or at least, as fast as humanly possible for a deep dive.
Exactly. Fast, data forward, no fluff.
Because usually when you analyze a company's quarterly earnings, there's this expectation of, simple physics at play.
Right.
You look at a traditional brick-and-mortar restaurant and you mentally count the cars in the parking lot. I mean, hedge funds literally do this with satellite imagery.
Oh, yeah. They track foot traffic in real time.
Yeah. And the assumption is binary. If there are way fewer cars pulling into the lot, the cash register at the end of the day is going to be lighter.
It makes sense. It's comforting.
It is. But Cracker Barrel this quarter is like looking at a mathematical paradox. The traditional calculator is just completely broken.
Well, and setting the stage here, you have to remember that Cracker Barrel is a really unique beast in the public markets.
Right. You can't just compare them to an Applebee's.
No, not at all. They operate this hybrid model. So they're a full-service restaurant, but they're also a specialized retail environment.
The country store.
Exactly. And that dual identity usually complicates things, but this quarter, it played a massive, massive role in these surprising results.
So let's jump straight into the headline numbers, because this is where the paradox really hits you.
Yeah, let's look at the top line. Total Q3 revenue came in at $797.4 million.
Which is a beat, right?
A solid $20 million beat compared to Wall Street expectations.
Wow.
Breaking that down, the restaurant side pulled in $658.4 million, and the retail side, the gift shop, brought in $139 million.
A $20 million revenue beat right now with this macro environment is huge, but revenue is kind of a vanity metric if it's not actually hitting the bottom line.
Yeah, and the profitability metrics here, they need some translation. The raw numbers are kind of distorted.
Yeah, I saw the GAAP earnings per share.
Right, it came in at a staggering $1.90.
Which is insane for a restaurant stock right now.
But
there's a catch.
A very big catch. You have to strip out this massive cash influx. They got a $47.4 million payout from an interchange fee litigation settlement.
Ah, the swipe fees.
Yeah. Restaurants have been fighting credit card companies over these swipe fees for a decade.
Because it just eats away at margins.
Exactly. And Cracker Barrel finally got their class action settlement payout. So almost $50 million in pure cash just drops onto the books.
Which is great for them, obviously.
Oh, Treasury loves it.
But it tells us nothing about how many, pancakes or rocking chairs they actually sold.
Right. So you have to strip that noise out. When you do, the adjusted EPS lands at $0.29.
Okay, that makes way more sense. And the adjusted EBITDA?
That came in at $48.3 million.
So the top line beat expectations, cash flow is solid, but, and here's the comp conundrum, we have to look at comparable store sales.
The comps.
Restaurant comps were down 2.6%. And retail comps were down 1.8%.
But the big number, the one that really jumps out, is the restaurant traffic.
The physical foot traffic.
Yes. The actual volume of human beings walking through the doors dropped by a whopping 6.7%.
Okay, wait. Let's just pause there. Traffic dropped by nearly 7%.
Yeah.
Yet they beat revenue expectations by $20 million.
I know, it sounds impossible.
It's like a bucket with a massive leak, but they're somehow filling the remaining space with liquid gold. How on earth are they pulling that off?
Well, this is exactly why you have to look past that headline traffic drop. If an algorithm just reads traffic down 6.7%, it sells the stock.
Oh, immediately.
But underneath that, management basically engineered the menu and the gift shop to extract way more cash from fewer visitors.
So they leaned into what we can call their value mode. Right?
Yes, they're shielding themselves from the pressure on the lower income consumer.
Because inflation is just exhausting everyone right now.
Totally. But Cracker Barrel's average check is incredibly low. It's just $15.85.
Wow.
Yeah, compare that to $27 in casual dining. Even regular family dining is around $19.
So a family of 4 is getting out of there for under $65.
Exactly. It creates this psychological barrier against cutting out the visit. And they're pushing this with barbell pricing.
Right, the extreme ends of the menu.
Right, so on one end, you have the $7.99 Sunrise Pancake Special.
Super cheap.
Very cheap. But on the other end, they introduced premium items like the new Smoky Southern Salmon.
So they get the budget diner and the premium diner.
Yeah.
But the average check still went up by 4.3%. How?
This is the genius part. Menu engineering for margin. The CEO called it the crack an egg on anything strategy.
I love that phrase.
It's so smart. They added all these low friction surcharges.
Like upgrades.
Yeah. Upgrade from 2 sides to 3 sides, add an extra breakfast protein.
Oh, and an egg wholesale costs what, pennies?
Pennies. So if you charge a couple bucks for it, the margin is astronomical.
So the guest gets this $7.99 deal, feels great about it, but then adds a sausage and an egg, and suddenly the check is $17.
Exactly. They're squeezing more blood from a shrinking stone, essentially.
But wait, the retail side really rescued them too? I saw this wild stat in the transcript.
Yeah, the retail outperformance.
For the first time in over 4 years, retail comps actually outperformed restaurant comps.
Which makes no sense in this economy. Usually people skip the gift shop to save money.
Right. You buy the $15 meal because you have to eat, but you definitely don't buy the $75 quilt.
Exactly. But they brought in a new VP of retail, Heather Hager, and she completely nailed the product selection.
What were they buying?
Sensory toys, fidget toys.
Wait, really? At Cracker Barrel?
Yeah, there's a brand called Nido that went totally viral on TikTok.
That is so random.
It is, but they also leaned into cheap nostalgia, highly collectible salt and pepper shakers.
Oh, affordable retail therapy.
Exactly. You won't buy the expensive quilt, but you'll spend $8 on a cute shaker for that little dopamine hit.
And didn't they also sell out of some patriotic stuff?
The American Heritage merchandise.
Yeah.
Yes. It sold so fast they literally had empty floor space.
So what did they do?
They put Halloween items on the floor in May and June.
June. That is unhinged.
I know, but it sold. The shrinking pool of guests just bought way more toys and Halloween decor on their way out the door.
Okay, so that's the defense, but they're playing offense too, right? With marketing.
Huge offense. The Cracker Barrel Rewards program is up to 12 million members now.
That is a lot of data.
It's driving over 40% of their tracked sales. And they use that data to launch a highly targeted sweepstakes.
The Fuel Your Summer Road Trip one?
Yes. They give away a $500 gift card and a $500 gas card.
Which perfectly hits the consumer's biggest pain points right now, food and gas.
Exactly. It's incredibly smart marketing.
But let me ask you a strategic question, because we hear this nonstop on financial networks.
The GLP-1 drugs.
Yes. Ozempic, Wegovy. Everyone says weight loss drugs are killing the restaurant industry. Did management even bring this up?
An analyst actually asked them about it directly, and management said they've seen zero measurable impact.
Wait, zero? How is that possible with a comfort food menu?
Because about a year ago, they reorganized the menu to be highly protein forward.
Oh, and GLP-1 users need high protein.
Exactly. Plus, they offer great portion flexibility. You don't have to order a massive meal. You can get the salmon with green beans or a $5 soup and salad combo.
So they completely immunized the menu against Ozempic.
They really did.
Okay, so squeezing more money from fewer people is impressive. But what about the rest of the year? What is management actually guiding?
This was the bombshell of the call. Management raised their full-year adjusted EBITDA guidance to between $120 million and $125 million.
Whoa.
Yeah, an analyst on the call pointed out that the midpoint of that guidance is a jump of more than 30%.
Wait, they are projecting a 30% jump in core profitability while traffic is down 6.7%.
Yes, and they bumped full-year revenue up by $30 million, too.
How does the math on that even work?
Inflation is finally cooling for them. They guided that commodity and hourly wage inflation will sit around 2%.
Okay.
But they're keeping menu pricing in the low 4% range.
Ah, so a 2% cost increase, but a 4% price increase. That gap is just pure profit margin.
Exactly. It flows right to the bottom line. But there is a catch with their capital expenditures.
I was looking at that. CapEx is guided between 105 and 115 million, right? Mostly just for maintenance.
Right. And the reason it's so low is because they explicitly paused their store remodel program.
Hold on. They are projecting massive EBITDA growth, partially by just freezing remodels to save cash. Aren't they just padding short-term margins at the expense of long-term brand relevance? I mean, how long can you let a store age before it looks run down?
That's the bearish argument, for sure. But management was actually really transparent about this. They didn't pause the remodels just to save cash.
Then why?
Because they tested the new designs and the guests actively hated them.
Wait, really? The guests rejected the upgrades.
Completely. The CEO said the feedback was resoundingly negative. People go to Cracker Barrel for that old, rural, country store aesthetic.
Oh, so if you modernize it, you destroy the illusion.
Exactly. It becomes just a generic dining room.
Yeah.
So they stopped. They're still doing minor updates like paint and bathrooms, but no more full-scale redesigns.
Honestly, saving money by just listening to your customers is pretty smart capital discipline.
Yeah. And they also executed a massive restructuring plan.
All right, saving like 20 to 25 million in corporate overhead.
And they slashed ad spend by $7 million.
Slashed ad spend by $7 million, yet they're running huge sweepstakes.
Because they shifted from expensive TV ads to targeted digital ads using their 12 million member loyalty database.
So they're just getting way more efficient.
Yes.
Okay, so bringing this all together for the listener, what's the bottom line here? Is this a bullish or a bearish signal for the stock?
I am taking a definitively bullish stance based on this call.
Even with foot traffic down 7%. Walk me through the why.
It comes down to operational leverage. Right now, it's coiled like a spring.
Right.
They just orchestrated a 30% upward revision to EBITDA while traffic was down. The restructuring is working, the ad cuts are working, the add-ons are working.
They built a better engine, it just needs more fuel.
Exactly. If you hold this stock or you're thinking about it, this is a textbook turnaround execution story. That $15.85 average check is a massive moat in this economy.
So what's the specific action item? What should we watch for next quarter?
Keep a close eye on the traffic comps. Right now, it's negative 6.7%. If management can use that loyalty program to just push traffic to flat, just 0%, not even huge growth, the profits will absolutely skyrocket.
Because every new person walking in is entering a highly optimized high-margin machine.
Exactly.
Wow. Okay, as we wrap up this deep dive, I want to leave you, the listener, with a final slightly provocative thought to chew on.
Let's hear it.
Think about this. Retail merchandise just structurally outperformed the restaurant business. People are swarming for their viral toys and vintage salt and pepper shakers.
It's a wild trend.
Right. And with the restaurant industry facing such intense labor and food cost headwinds across the board, is Cracker Barrel slowly, quietly evolving?
Into what?
Are they transforming from a restaurant with a gift shop attached into a highly profitable, nostalgic retail giant that just happens to serve pancakes as a loss leader to drive foot traffic?
Reframing the whole restaurant as a customer acquisition tool that completely changes how you'd value the stock.
It changes everything. It's something to think about. Thank you for tuning in to this fast-paced, actionable deep dive on Talk Tickers.
Yeah, keep your eyes on the data.
We'll see you in the next deep dive.